So figure that's about 50 pips. Okay. 2124 in this range, which is going to be the bottom of this box. 2124, right? That's cool that I could find that on both charts naked and find the same place approximately. I'm just saying, kind of cool. So I'm looking for here, here. It's about 50 pips. You're protecting, locking, scaling, or trailing based off of your management style. Beyond that, you're going to be looking here. You're going to be looking here. This is kind of like that extra area. Okay. We're going to pay very close attention to see what price does. By the time we come down here and break this zone, I'd expect a retracement. I'd expect some money to pull back, right? They're going to want to see people are going to be trying to buy this back up because that's going to be have been a discount price, right? So we'll see if we're going to come all the way down into here or not. It's going to be a pretty good ask. Otherwise, you do have some targets marked up just in case. And that is that. I zoom
Uh,
out.
Can I point something out here, Jenny?
Of course, yeah.
If you zoom in just a little bit, that's good. If we look at the places where Jenny has her lines drawn, like right now, we kind of line up with this. Notice that consolidation area? When you consolidate in a space like this, that is the market kind of agreeing on price. This is a fair price level. So another one here. When I'm starting to draw these, I'm doing it from the left side. So, we look at this one's a little less clear, but it is there nonetheless. And we have a little bit of one right here. We're sort of in that consolidation zone. So these areas like this is market saying this is a good price. It will be trading at this level for a while. We've got a big one down in here. And those are levels that you can project forward. The areas between those levels is repricing of the market.
Scott, that's a good, thank you so much for explaining that. You're so good at that. If you keep that stuff here, this is a good time to say, why do I never target this area? Is because remember, we've seen this happen with slippage, but a lot of people try to lowball their stop loss and over exaggerate their take profit, right? I do the exact opposite. And I'm not saying it's the only way to be, I'm saying it's a very good way to be. Remember, you're battling against the market itself, the psychology of the market, the actual fundamentals, the actual technical analysis, and the broker and all their slippage and all their spreads and the liquidity provider. You're at war against and with a thousand different elements. I am not targeting right here because I want to be out or have closed or have managed my trade before I get to here. The reason why my entry is my levels I mark here toward the middle or toward the top of that box and never at the base of it is because remember, if price sits here, right? Let's just say price comes all the way down into here, but the spread opens up and it just, it springs into this with a big old wick, but the spread opens. If I am not out or at least managed or take profited or something or have some kind of exit management, price can come all the way down into here, shoot back up and close nothing. We've seen it happen. You guys have screenshots. I have screenshots, right? This says price does that all the time, especially in big spicy moves, session crossovers, news. So my areas that I mark up, I want to manage before I break this zone. So before, because the likelihood of hitting the bottom of this box, as Scott drew it, is very high. The likeliness of springing into the bottom of this box with a wick, very high. But I need to be out before then. I need to have managed before then. This way I know I'm getting my money off the table. Otherwise, let's just say price comes down and does all this stuff. The wick comes and clears this area, but I didn't have any kind of take profit or management or anything at all, and I'm not doing anything. That spread could be this big, depending on the broker. I have collected nothing and I lose the entire trade, especially on the micro time frame, on the smaller time frame. It's a good example of that visually, just so you guys can see it.
And sometimes price will just dip into the box.
Yes.
It'll dip in like this, and then it'll shoot up. So, getting out before the box
Cool.
can be the safer bet. Expansion ranges are often bigger than the boxes.
Right. Well, was it Future Millionaire who posted, would you rather have, I think it was a pretty extreme, it was like 0.5 or 0.6 to 1 or something like that, and a 90 something percent accuracy, or 1 to 1 and a 50% accuracy, right? He posted some concept that was comparable to that. And Paul, Discord group, he did the math. He's super smart, right? he was like, let's just do the math. And he broke it down. He's like, this is going to equal me a net blank, and this is going to equal me a net blank. The winner, when you do the math, is you'd rather have the one that gives you way less favorable risk to reward and a higher accuracy in the big picture than the one that gives you 1 to 1 or greater and a lower accuracy. Because for multiple reasons, just the math alone, the money alone. But secondly, and I know Scott and I have talked about this on live calls before, you're way more likely to hit the 0.5 to 1 than you are to hit the 5 to 1. So the odds are also stacked in your favor. And that again leans back to that accuracy topic. So it becomes easier to win, which I just think is definitely super cool.
Yeah,
Definitely
it's
super
always
cool.
a trade-off.
Yep. Yep. Yep.
That you're talking about, Jenny, too. I believe like if you played around if someone were to play around in the Monte Carlo and like do it with like I guess smaller numbers and show the compound effect, like let's say you adjusted it where you had an 85% accuracy and you were just doing 1 to 1 or even risking like maybe 1.25 to get one in return. Like over time with that accuracy you could compound the account much faster as opposed to going like even 1 to 2. Like 1 to 2, you would get more gains, overall over time, but the process would take longer. Where in a short period, those 60 trades that the Monte Carlo would show you, you would get substantially a higher gain because obviously you're going 1 to 1 and the growth of the account is escalating at a faster rate. So eventually, you may take you a while to get to those big numbers, but once you start getting to them, then it just goes sort of parabolic because now you're compounding bigger numbers at 1 to 1 ratios.
That compounding bigger numbers at 1 to 1, it changes the entire direction of your trading. That's a great point. And if you haven't done so, play with that Monte Carlo spreadsheet. Just treat it like a video game. Play with it for a few hours. You might be surprised. You'll geek out. You'll be like, oh, wait, I can actually do this in one account. You can do that in one account. You can do that in, 2 or 3 accounts if that's your wish, or a couple prop firm accounts. But that's a good point.